Hello everyone. Today we are going to get started with options. This is a sequence of two chapters on options. This first one is where we are going to spend most of our time. This one is about understanding the basics of options and how the option payoffs work. Also looking at some popular options related strategies. And then the next chapter is a bit about option pricing. We are not going to spend too much time on that topic. We will just discuss that at a more conceptual, intuitive level without going into too much of mathematical details, right? Uh, this is a good a topic to provide a foundation for advanced learning in derivatives. For example, if you are looking to take the 444 options and futures class, I think you should get a good foundation for taking that class based on our discussion here, right? Uh, we briefly mentioned options earlier in the course in, I believe, our very first chapter. Uh, Options are a type of derivative securities. So if you think about, say, stock options, right? So a stock option is an option on a stock. So the value of the stock option would depend on the price of the underlying stock. There are two types of options. We have a call option and we have a put option. All right, so let me just carefully go over the definition of these options, and then I'll illustrate this idea of call and put options with an example. So as you can see here, a call option gives you the right to buy the underlying asset at a fixed pre-specified price, that is known as the exercise price, on or before a particular expiration date, right? So the right, not an obligation, a right to buy the underlying asset. So underlying asset could be a share of a stock, for example, or underlying asset could be some commodities, fixed income securities. Options can or options are out there on many different types of assets. So if you think about stock options, right, just for the sake of discussion, we'll continue to focus on stock options. So our underlying asset is the stock. All right, so if you think about say IBM or Microsoft, right? So IBM shares, when you buy a call option on IBM, it gives you the right to buy a share of IBM at a fixed pre-specified price, irrespective of IBM's actual market price. So you can lock in the purchase price, and irrespective of the market price, you will have then the right to buy that share of IBM at that fixed pre-specified known price to you at any time up until the expiration date. So unlike stocks, options come with an expiration date. And then some of this terminology here is strike price or exercise price and the option premium. That would be clear once we look at the example. So actually, let me directly go to the example here. Um, this is the example from your textbook. So I'm intentionally using this example so that you can refer to your textbook and see if you can follow along. If there is any confusion, you can always read through the discussion in your textbook. So this quote for IBM options, right? So these are IBM options. This is the quote from Wall Street Journal. This quote is from August 24th, 2011, right? So August 24th, 2011 is when you're seeing this quote, and all the expiration dates are therefore in the future, right? So that's September, October, January 2012, and so on. So if you look at the option quote today for any stock, you will have expiration dates at some point in future, right? So for example, you might have expiration in June or August or September, things like that. Okay, so let's look at this very first row here, and let's go through this item by item. First of all, notice here that IBM stock price at this time is 166.76, right? So IBM's stock price, this is the actual stock price for IBM, and the quote is for the options on the IBM. On this left hand side you see the quotes for the call options, and on the right hand side you see the quotes for the put option. We'll focus on the call option first. Okay, so first column is expiration. Now you see the expiration here, September 2011. The actual date is not specified here. For these options that you see quoted here, these are standardized options. For most part, the options expire on the third Friday of the month, right? So all these options that you see here, they all expire on the third Friday of that particular month. There are other expiration dates too, but this is something that you commonly see, and that's the reason why the specific date is not mentioned here, because it is known that the expiration is the third Friday of September in this case of first option. All right, so let's put a specific date there, just randomly. So let's say the actual date is 20th September, right? September 20, 2011 is when this option is expiring, right? So let's just assume that September 20th is the third Friday of the month. So 20th September, the date of the quote is August 24th. So that means this option is expiring in another 27 days, right? To August 24th to September 27th, 27 calendar days. All right. So that is basically this first column. These are all the expiration dates. The second column says strike price. This is also known as the exercise price of the option. And what this is basically that fixed pre-specified price at which you can buy a share of IBM. So if you buy this first option here, right, that is expiring in September 2011 with this 160 strike price, what we are basically getting with this option is to buy a share of IBM stock for $160, fixed price of $160. The actual market price of IBM might be 170 or 180 or 200 or 250, whatever that price is, but you are locking in your purchase price of 160, right? So when you purchase this option, you get the right to buy a share of IBM for $160 at any time up until September 20th expiration date, right? So irrespective of the market price, you're locking in the purchase price. Of course, this is a right. All right, so like we mentioned in the definition here, right to buy the asset, right? So this is a right. This is not an obligation, meaning that if you would want to do this, you would want to buy the share for 160 only if it is favorable for you to do so. Uh, you don't have any obligation to do that. If it is not favorable for you to do or to undertake this particular transaction, you can choose not to. All right, so you have a right. There is no obligation. You have the right to buy at 160, but there is no obligation to buy at 160. Of course, this is a valuable right that you are getting. Uh, and by the way, that's why these options are called options, because you're getting a choice here, right? You have an option to either buy at 160 or not buy at 160. I mean, it's depends on how the stock price changes over time. So of course you're getting this valuable right, so you have to pay something in order to buy this option. And this next column is basically the option price, $9.15 per option, right? Each option will cost you $9.15, and each option gives you the right to buy one share of IBM, right? So you pay $9.15 today, or on the date of this quote, and by paying $9.15, you're basically logged in your purchase price for one share of IBM at $160, and you can buy it at that price at any time up until the expiration date. So by paying this option price, this you're basically getting this right. Okay, so this option price of $9.15, that is what is referred to as the premium. All right, and then this fixed price of 160, that is known as the strike price, or also known as the exercise price, right? So strike price or exercise price, so that is this second column here. All right, and then the other information here is basically the trading volume. So now one important thing to keep in mind is that unlike shares of stocks, options generally speaking trade in round lots of 100, meaning that you cannot go and buy one option. You have to buy it in lots of 100. So you have to buy 100 options or 200 options or 300 options. You cannot just buy one option of IBM. The price that you see here, $9.15, that is the price for one option. All right. So what would be the price for 100 options or one contract? So one lot of 100 options is known as one contract. So that's an option contract. Contract includes 100 options. What would be the price of one contract or 100 options? We'll just multiply this by 100, $915. All right, and that is the minimum you would have to invest. And with those 100 options, you're getting the right to purchase 100 shares of IBM at $160. Okay, so one option gives you the right to buy one share. Since you buy in round lots of 100, one contract or 100 options give you the right to buy 100 shares of IBM. This is the trading volume. This is again in terms of contracts. How many contracts were bought or sold on that particular day? This is the open interest, and this basically just means that how many total options are being held by investors at that particular time. Okay, so this is how to interpret this quote, and you can see that similar information is there for options expiring at different points in time. So this is the September expiration, but there are also future dates that are listed over here. All right, so this is the basics of call option. All right, gives you the right to purchase a share at a fixed pre-specified price up until a certain expiration date. Because you're getting this valuable right, you have to pay something in order to buy this option, and that is basically this option price. All right. uh, okay, so one thing also to keep in mind is that just like we have the bid and ask price in case of other securities like shares of stock, you also have the bid and ask price in case of options. So $9.15 is basically the last price at which the trading took place. But in general, when you actually look at the quote, you will see a bid price and you will see a ask price. Ask price, as you know, is higher than the bid price, so you will have to pay a somewhat higher price to buy the option, and you can sell the option at a relatively, or you will be able to sell the option at a relatively small or smaller price. All right, so continuing with this example here, we're looking at this first quote here. Now you have the right to buy a share at any time up until this expiration, and we are saying the expiration date is September 20th, right? But let's assume for now that you hold on to this option right till expiration. You don't do anything, you hold on to it till expiration, and then at expiration how things work out, right? That's basically, it would depend on how the share price is changing over time. Currently the share price is 166.76. All right, so let's look at a couple of possible scenarios here. Let me write down that basic information. Current stock price, it's 166.76. Strike price or exercise price, we denote this by X. Strike price is 160, right? And then we are looking at and also let me put the premium here. Option price, which we refer to as premium, is $9.15. Okay, and then let's look at a couple of possible situations here. So let's say at expiration stock price is 175. So at expiration, the IBM stock price has gone up. It was 166.76 when you established this option position, and now it is 175. All right. uh, you are holding this option, and we are going to work with one option situation, right? Let's, for each option, what is your payoff like, what is your profit like. So for each option, right, how things work out. So you have this option, right? You purchase this call option, right? Let me make that clear. Call option price, right? So you have the right to purchase a share of IBM for 160, right? That is the fixed price irrespective of the market price. Now you're right, at expiration you have to basically do something. Would it make sense for you to buy the IBM share at 160 at this point? It would, right? Because the actual market price is 175. So what you can do is you can use this right to purchase IBM share at 160 and then immediately sell your share for 175 in the market. So you use the call option to buy the share for 160, that is known as option exercise, and immediately sell the share in the market at the prevailing market price of 175. What's the difference between the two? The difference between the two is what we refer to as the payoff. Payoff in this case is 175 minus 160, right? So you make how much in payoff? $15, right? So that's right at expiration. You're exercising the option and you get $15 at that point. You use your right to purchase the share at 160 and then you immediately sell that share at the market price of 175 and you get $15 at that point. But of course, this is not your profit, right? This is what we refer to as payoff. This is payoff at expiration. You also paid this $9.15 to purchase the option. So what is your net profit from this position? Net profit. So you get $15 here at expiration, but then you also have to pay $9.15. So that's your cost. The difference between the two is $5.85, right? $5.85. This is your net profit from this option position, right? And this is of course before transaction cost, right? So we are not accounting for any commissions or bid ask spreads and things like that. So we are ignoring those things for simplicity. So this is before transaction cost. So this is how much you would end up with. For each option, you will make $5.85, right? And for one contract, that would be $585 and so on, right? So this is the favorable situation. Remember, call option gives you the right to buy at a fixed price and it is a bullish position, right? You're hoping for the price to go up because your purchase price is locked. So you want the price to go higher and higher. The higher it goes, the more profitable would be your position. Okay. Now, if you look at this profit in percentage terms, uh, you invested how much to purchase this option? You invested $9.15. And how much was your profit? Your net gain, $5.85. So that's a huge gain for this position, right? On your $9.15 investment, you end up making $5.85. That's almost like something like 60% profit in a relatively short period of time. And that is when the stock price has not gone up that much, right? When you established this position, the stock price was 166.76 and it went up to 175, right? So stock price went up by like 6% or something, but 5%, right? 5-6%. But your position, option position, earned a profit of almost or something like 60%, right? So that's a huge profit. So this is a favorable situation, right? That when the price goes up. What happens when the stock price goes down, right? So now let's actually look at another situations, right? So let's call this case 1 and let's look at another possibility, case 2. at expiration, let's say the stock price is 155, right? What would be your payoff here? So now remember, you have the right to buy the underlying stock at 160. There is no obligation. You don't have to. Okay. So don't compute the payoff here as 155 minus 160 equals -5. Now, in this case, would you want to buy the underlying stock at 160 when the actual market price is 155? Well, it won't make sense to do that, right? Why pay more than the actual market price? So in this case, you will choose to not do anything. Again, you are waiting till expiration, right? This is at expiration. Your stock price is now 155, uh, and you have the right to buy the share at 160. So this is not a favorable situation for you. You would choose not to exercise this option. You would choose not to exercise this option, not use that right to purchase at 160. You don't want to purchase something for 160 when the actual market price is lower. So anytime the price is 160 or lower, you would basically not do anything. You would just let this option expire. It will expire worthless. Your payoff would be zero. What about net profit? So in this case, again, your payoff is zero, so you don't make anything at expiration, but you have paid this price of $9.15 upfront to buy this option. So your net profit is a negative $9.15, means it's a loss of $9.15. So you basically lose the entire premium, or the entire price that you paid for the option is gone in this case, right? This is 100% loss, right? You lose your entire investment. If you buy one contract, you invested $915, $915 is lost in this situation. So anytime the stock price is 160 or lower at expiration, you would not exercise the option and you will have a 100% loss. You would lose the entire premium. So now comparing these two situations, you can see that options actually can be quite risky, right? If you just have like a call option position, if price goes up, you can make huge gains, but if the price goes down, you can actually end up losing a huge amount of money, 160 or lower, right? So in this case, there is like a huge range of prices over which your loss is going to be 100%. All right, so that is how options work, and this example illustrates the riskiness of option position.